Good morning. All right. Today, I want to show a little about how I see things going. I think as we also kind of hint in the topic of today, that we are going to see a continuation of the bull market for now, and that is Central Coast of California. You must be up really early. That's amazing, or late, or very late. We have a continuation of the bull market for now, and it's not something that is going to be there for the next 12, 18 months, as you probably see a lot of people talking about. That's not how I see it right now. And again, I want to show you a few things here now, and that is trying to explain, first of all, that there's a big difference between, and I want to say this again and again, that the moment where you get a structural damage to the hull of the Titanic and to the moment where it actually goes underwater. This is the difference. The moment when you get the structural damage, well, there's no going back. It's going to sink. And then you have the moment where people actually get into the water, and that's two different, times, or two different events. So for now, if we look at the economy, and this is based on the newest information I have on the business cycle, and this is something that will be updated again and again, but this is from early here to October. We have what we can see here, a very big decline in the leading indicators. And the leading indicators are telling us that things are deteriorating, like what we have seen before. And I don't need to probably go through it all again and again, but we have seen it all the way back here into the 50s, actually, that when we again and again see that the leading indicators are doing this crossover, it's just a matter of time before we see it then coming into coincident indicators. And the coincident indicators is what we feel. That's employment, manufacturing levels, GDP growth, and so on. We did not get a crossover here by the end of Q3. Just like what we saw in Q3 of 2007, where we didn't see the crossover in the coincident before in November of 2007. Actually, didn't get confirmed by before December, but if I look into the numbers, you could see it actually crossed over in November. We have it here, and we got that in November of 24, but it means that this is the structural damage that I'm talking about. This is when we are actually starting to see that the ship is sinking. And we don't get that just yet. Even with the revisions that we have seen in August on the non-farm payrolls, it didn't push it below. I can see that the deterioration that we have now in the labor market is telling us that this may come. But again, we need to understand that we should not call it too early. And I think I may have to improve my communication in terms of how I talk about this. And because when I said a recession is coming for a long time, it's because when we saw this, that we could see that the deterioration of that was actually so strong that it was going to cross it. We then went sideways for a little while, but now there's no doubt. That's why I've been so, saying that it's coming, but it's not coming yet. And I'm still saying that, and I will keep saying that until we see that in what I call the imminent recession indicators, which are indicators that tells us now is the moment that the water is coming up and we're starting to get our feet wet, even on first class or second class. Because the third class, I can tell you, is right now underwater already in the US and elsewhere around the world. If you look to ordinary people, the bottom half of the population or the income levels, they do not feel well. And I don't care what people are saying on Twitter and elsewhere in the financial world when they talk about, we have all these indicators. This is what the Fed is looking at all the time as well. And again and again, they are wrong on their outlooks because they do not observe the 70% of the economy, which is the real economy. That's the consumption, that's consumers. So this is what they apparently do not understand, and I would love to speak to somebody at some point from the Fed to ask them why is it that they, when you have journalists asking you that, what about the Fed? Sorry, what about the consumers? And you simply do not, apparently do not pay attention to them. That was what Powell didn't do 3, 4, and 5 months ago when he was asked, what about the consumer confidence? And he kind of, just brushed it off. And now we see the labor market is actually deteriorating. So we do not get the signal as a structural signal that is crossing over here, which gives us a little more time from this perspective, and that is great. And if I just go to some of our charts here as well, and you can see I'm working with a lot of things these days. So let me just start to show you a little of the structural damage we have. The structural damage comes first of all, and you see this many times from the housing market. Because what happens in the economy is that when things are starting to, when the party gets going, when we have a good time, then interest rates move up, yields moving up, because the demand for loans and so on is pushing the price on loans up, and that's interest rate. And that means that it's getting more expensive to take out a loan, and that's where people start to say, oh, maybe we don't want to build that extra whatever it is to your house or expand it or anything. We'll wait for when we can afford it. And at some point, that actually spills into the real economy because then, if you look here at this one, this is the sentiment among builders of U.S. single-family homes, and is widely watched since housing represents a large capital investment and spurs additional consumer spending on appliances and furnishings, and housing market indices helps to monitor the overall health. It's because it's such it's a big part of our economy, our personal economy, that what we spend on our houses. And that's why when that starts to roll over, and especially the harder it rolls over, the bigger the drop that we see later on. But it always takes a while before it happens. This time around, we have seen this drop coming actually after what was an artificially high spike here after Corona with all the stimulus coming out. But we did see something of a top, let's just put it here then, and we have seen then a decline here. We have seen it consolidate for quite some time and treading water, and then we've seen it breaking down lower here. I don't think it's done declining, and I definitely do not think that the unemployment or the acceleration in the unemployment rate is what we have seen yet. What we have seen every time, just with a lag. It comes every time, and the bigger the drop, the bigger the rise in the unemployment rate. It's inverted here. So the structural damage is still there, and you cannot tell me with the current affordability that things are great. There's nobody. I mean, people. You look at the home sales, existing home sales. It's in the gutter. So there's no structural improvement to this. And this is what is slowly coming to, and that's what the leading indicator has been telling us, because that's part of the leading. And then you have the coincident telling us, oh, but we're starting to see that into the labor market as well. And you got to be really stubborn to not, appreciate that there is a decline here now. And especially, I was, pulling out my hair here in May, June, and July, because where do we see that slowdown? Because the slowdown that I talked about from the leading indicators in early in November of 2024, we should see that coming into the labor. And then we had the revision in August, and boom, all of a sudden it all made sense again. So the model was right on. It was simply the employment numbers that were wrong. I don't know for which reason, but they are often very wrong. And this is what I want to talk about also, because if we look at it with the non-farm payrolls, the difference between the non-farm payrolls and the full-time jobs is that the non-farm which we have here, and I just want to get back to that, but the non-farm payrolls are based on the let me see, what is it called? I can't even recall it now, but there are two surveys, and this non-farm payrolls are based on a survey where they go out and they talk to 120,000 around that businesses and ask them, did you hire people in last month? Oh, yes, we did. So, okay, how many? 5. Good. Nobody asks them if it was part-time jobs or it was full-time jobs. And obviously, a business that is hiring in 5 part-time people are actually only hiring in 2.5 full-time employees. But that's not what the non-farm payroll is telling us. That's just telling us a job is a job. So it could even be less than a half-time job. So when that even declines, well, that's not a good thing. And then we can look to the full-time employees, which is from the household survey. That survey I do remember. I can't remember the name of the other ones, but probably one of you shop guys can remember it. But the household survey is where they go and ask households instead. And they ask around 60,000 households and say, okay, so did you get a job last month? Yeah, I did. Good. Full-time or half-time, part-time? Oh, that was part-time job. Okay. So there you actually get this distinguishing between a full-time and a part-time. And that gives you a little better quality to the number. So, and obviously, an economy that is generating a lot of part-time jobs is not as strong as an economy that is generating a lot of full-time jobs. And then there is the thing about the momentum of the economy, which a lot of people have been telling me you cannot use momentum into economic data. Of course you can. Of course you can. It's just data. I mean, data, and they can have a momentum, a trend to the upside or to the downside. Physicists will tell us that also. So it's about understanding that the economy is like a super tanker, and the super tanker will turn, and when it turns with a certain momentum, then we need to observe it. Back to the story. If you look at the full-time employees here, we can see how that going into the financial crisis and the 2001 crisis, we see that it seems like it's going higher, but you actually have momentum-wise a slowdown. This is called divergence. We know that from financial from stock charts as well. This is very important. It simply tells us, is this trend strengthening or is it weakening? And if it's weakening, then there is a larger chance that it can turn all of a sudden. And you can see it in here. You can even see it into the financial crisis, which, by the way, was not just because of this is the COVID situation, or COVID crisis, was not brought about by COVID by itself, because the economy was actually stalling already, and our business indicators was also picking that up. It actually had the recession signal on the leading in August of 2019 and on the coincident in November 2019. So this one actually picked it up on this with the COVID, and we can talk about that another day. So the slowdown was visible there as well. And we can also see on the employment rate, it was rolling over, not so much here because we didn't get as far into it before COVID then actually came along. And the Fed actually, due to that, kind of responded in a more timely manner than what they do now. But back to that later. So now we see the full-time jobs actually have been rising, but we see the slowdown of this. And you need to be, again, a little stubborn here to not to say, well, could we actually see somewhat of a decline coming based on this dynamics here? I think that there's a risk of that, at least. And we can see also how the number of full-time jobs have fallen, but just marginally. And that's why we are not at the full-blown waterfall moment at this point. And this is the difference between, again, Titanic hitting the iceberg, starting to sink, and then the waterfall where it goes straight down. We are not there yet, but we have the indications. People cannot tell me we don't have the indications. We do. And we know also another indication by itself is obviously when the Fed is cutting. And actually, there is a great chart out there these days, which shows us that if you look to the rest of the central banks of the world, then we had, I think it was 200 and some cuts into the financial crisis. And we had 180 cuts or something like that into the COVID situation, which I said was also a slowdown. Now, this time, we are already at 169 cuts around the world from different central banks. So we are at the third highest peak already in terms of cuts from other central banks than the Fed. And then you can think it's because the Fed knows better, or it's because the Fed is behind. I know which one I'm leaning up against. So if you look to the Fed also, when they begin to cut, they don't do that because things are great or because they want to make euphoria in the stock market. What they do is that they try to counter the decline that they see coming in the economy. And they may be a little blind sometimes, but when they, and we can see that here with the unemployment level again, when the unemployment level puts in a rounding bottom here and starts moving up, the Fed realize that something is wrong, we need to cut. And I don't need to put it in for all of these, but you see this was kind of a double recession this, so we can take it as one. And then you had when they cut here again. Here they kind of tried to counter it, but then really when it's, and then it started here, cutting right into the moment of the recession. Here, the financial crisis, they started to cut in September. They did a 50 basis point cut, but it was way too late. And we remember that. It was way too late. September of 2007 when they started to cut. And in December, the recession set in. And in February of 2008, Bernanke was out there saying, guys, by the way, if we see any hints of a recession, we will act decisively. And guess what? We were 3 months into the recession at that point. So the Fed they don't have the tools. We just have to acknowledge that. But they will be cutting when they see it. And we can see now, you can just make your own mind up here and say, does this look like are things great here, or what do we think about this? I know what I think. I think that we're going into a recession, and that's what my model is picking up. That's why we start to see the development also in some of the more initial initial recession indicators. We don't see, as I said, the waterfall moment. We're not seeing this part yet, which means we can still have time. And this is where it becomes really tricky, because I know people saying, but if you're saying a recession is coming, then we need to get out of the market right now. That's not entirely true, because you can actually see that and especially if you look at the business cycles, that it can last for some time. You can actually see that it can go on, especially when they try to pump the market with liquidity, and especially the last phase of that, which I also will get back to here. You can see that the stock market can rise rather fast, but it doesn't take away the structural damage. It just gives us a hype in the market. So, and this is apparently what is difficult for people to understand, that the Fed actually do not have these, godlike powers. If we just for a second also look at inflation minus the Fed fund rate, what does that show us? Well, it actually gives us an idea of whether the Fed is actually kind of dovish or hawkish. So if you have inflation and you deduct the Fed fund rate, then you can say if it's a negative number, that means that the Fed is actually kind of hawkish, because the Fed fund rate is higher than what the inflation rate is. And that, there's not a right or wrong level, but the more negative it is, obviously, the higher above inflation rate the Fed is, and they're being more hawkish. At this point here, we're down here at minus 1.32 is what it's indicating here. At a time where, again, we see, as I put it before, the unemployment level is clearly moving higher. The momentum of the economy is telling us that it's stalling, and the Fed is still playing hard to get, which is ridiculous. And again, I would love to ask somebody from the Fed one day to say, what is it that you're looking at? What is it you need to see? Why is it that you need to see even more? How many indications of something do you need to have before it's a cat? It says meow, it's, I don't know, furry, it's got a tail, and it kind of like to chase mice. How many indications do you need to see in order to say something bad is coming? And I could give you many more than what we look at here, but the unemployment level is one of the most basic ones. And I don't know what they're not seeing. Then they say, yeah, but we're afraid of inflation. But guys, inflation is something that lacks. It actually, we just need to understand the supply chain of things. And we can see it also. If you look at inflation, it's something that rolls over later. It always does. When the inflation going up even into 2008, it came down strongly. I don't think anybody would say that by the end of 2008, inflation was a problem. It was, and inflation was at the beginning of mid 2008, it was up at 5%. It was not a problem with inflation. And that's where the Fed looks out the rear window, because inflation is also, according to the business cycle model, a lagging indicator. So if you follow that, it's like driving ahead, but looking out the rear window while you drive. It's just crazy. You cannot steer the car. So this is what's happening right now. But I also want to say here from this, if you look at actually the reason why we have what I call the everything bubble is because of what we have here, the period where they were far too dovish. And that is the period where we have seen all the creation of a lot of assets which yield nothing, and everybody thinks is just, godlike. Let's see how that all develops, but this is the reason why we have these extreme valuations that we have. And then let's move to the stock market, because obviously that is what we all want to look at. I say that we still got time. As I said, the imminent recession indicators are not flashing yet. I will not call the onset of the recession. I'll say the recession is coming. Yes, I'll stand by that. And of course, people say, yeah, but then it's 5 years out. No, it's not like that. It's because we have evidence that there is structural damage. And I want to say that the imminent recession indicators are not telling us it's right here and right now. So we still got time, but it's also coming to what I think can be closer and closer to an end. There are some indications. This is the next level of my framework, is where we look at the at the Elliott wave extensions, and the S&P 500 now suggests where back in 22, and everybody said, Henrik, you said 6,000. Yes, I did. I said 6,000 back when we were here at this point here back in September, October 22. Because that was what I could see based on the Fibonacci extension that gave us. That was actually based on this one you have right here, 6,200, which is right here. We got that. When you get closer, then you can see that actually this is going to expand into what is going to be a more of a vertical kind of thing, and an extreme bubble. And then you have to adjust a bit. But that is why things are changing. So people are coming after me and said, Henrik, 2 years ago, you said 6,200 or 6,000, whatever. And said, yeah, it's not like I have a crystal ball. I have Fibonacci levels that I can follow. And that's what I base it on. So right now I'm saying, yeah, 6,200 was that. We reached that. So from what we said here. And now it seems like we could actually reach something as crazy as 7,200, 500, and even 7,800 in this blow-off top. Again, this is not something we would like to see, because especially when we look at the divergence here. And this is one thing I put onto X here the other day, and you can take a look at that. I will show you. But when we look at divergences into larger tops, here we had a divergence into the financial crisis. Here you had the divergence into the .com situation. And we know how bad they were. Here was a NASDAQ down 85%. Here we had it seemed like the world was coming to an end. The financial world will come to an end. This is what we see in there. Even here, we had it into the decline in 2016. Now, see, what we're looking at right now is so extreme in terms of this divergence we have. And actually, Elliott wave wise, this is one gigantic topping pattern which actually tells me that we have had a massive bubbles beginning all the way back here in 18, and especially after we got the COVID stimulus in 2020, which has just sent us up, an extreme way. And when I call it a blow off top, guys, and people say, "Well, where is your blow off top?" I mean, just look at these candles here, 3 months candles. Look at them and see how extreme they are. I started calling it blow off down here. Look at the extremity of these. You have candles here, and you have it into this final phase here. You cannot tell me that this is not that this is normal. It is not. So, but we're not there yet, and that's the thing. We're not there yet, and we can see here when we have the business cycle telling us that we got a recession signal in the coincident indicators, then we can actually people telling me we're in 98 now because the Fed is cutting. That bullshit. We're not. We are 98 was down here somewhere, and that's not where we are. We are more like what we saw into 2007, where we actually saw a 30% rally, even after we had one of the bigger declines, which can't hardly be seen here, but we had that in March and also in August. And the same thing into also to 2019. We see how momentum here is telling us, oh, the air is going out of the balloon. That moment, the air is coming out of the balloon is already, we had that here. That was the March-April situation. But that still meant that, and we could see that things could still move higher after that. What we're looking for is the imminent recession indicator starting to decline, which is what we see here, short-term yields and yields spread and credit spreads. And they are not indicating things are terrible at this point. See, that's the difference. So I will not call the top in the stock market before, even though we reach some of the levels, before we start to see some of those imminent recession indicators actually starting to flash. But I can wonder and look at this stock market and say, okay, if you look here to the FANG stocks, for instance, and there are somewhat of a level up here, maybe, and this is where you use theories and you put up, hypothesis, say maybe this is where it all ends. I think it is. I think that is where it ends. So we have a divergence also on the FANG stock, just like what we had down here, just in the opposite direction on the FANG stocks, where I actually called the bottom in the market back then. You can go back in next and take a look at that. And that was because of the divergence we had here, and also because we did not have a recession, as according to the business cycle model. This time is different. This time we have a recession coming, as according to the business cycle model. Plus, we're reaching the levels here, and we have all the complacency in the world right now. I hear that from everywhere. So I think we are heading into something, but it doesn't mean that it ends right here and right now. And that's what we need to understand. Can it be 2 months, 3 months, 6 months? I don't know. There's one chart I want to show you. And I think that is what we need to really, and that's one of the reasons I also actually back in the days of when we had the crash here in April, and everybody was telling me the NASDAQ had made a top in December. That was the top at that point. And that we'd not seen that would be the big top. And you could see how the Singaporean index had been moving higher into February and March even, which means that the Singaporean index, which is a very sensitive index to trade, and this was again we have the situation with tariffs, and that was the reason. And the Singaporean index highly sensitive to trade. That if that index was moving higher, while the NASDAQ topped in December, maybe it was because there was not a top in NASDAQ and was going to come later, which turned to be correct, even though BlackRock CEO and everybody else was talking about a recession. We did not see that at that point. But today, it's different. And that's what I want to say. Today, it's different. We have a situation now where if you look at the Singaporean index, you actually have a situation where where we're heading into what can be a massive top here. What we have seen since 2009 here is actually just a bounce in the market. I know this sounds crazy. I put up an article also on X and Substack saying we never left 2008 because we just painted it over with liquidity, and that does not solve a thing. It gives us the feeling of wealth creation, which is also what Ludwig von Mises tells us, that we can have certain period where it feels like we are all getting richer and everything's fine. But actually, in the real economy, things are not great and has never actually improved. And you can just look at the debt levels, where the US has put on 60, it was at 60% debt to GDP. Now it's at 120. So a lot more debt into an economy. And of course, you're going to get a fiesta on that. And that's what we have seen, even though it's taken 17 years. But we're now heading into something what could be a top. This is where I become really concerned if we see a top in the Singaporean index, because that could trigger a top in the rest of the markets around the world. Because as I said, this is the canary. I didn't say that right now, but it is a canary in the coal mine. So let's see what happens if it just moves a little higher. Could that be October? Yeah. Could it be November? Yes, sure. Or December? Correct. We don't know when, but we are observant because of the Fibonacci levels and because what we see in the fundamentals of the economy. That's how you cook macro, as I see it. So with all of that, as I said, this is a Q&A, and I actually think I've talked a little too much here now. Let's head on with some of the questions. Could you play devil's advocate with your opinions regarding for how long the topping can drag out, dollar weakening, depth and speed of the crash? Yeah, but I'd love to play devil's advocate and find that you put up this about the dollar weakening. Yes, the dollar is weakening, but actually, if you look to it, it is actually showing a bottoming phase now. So everybody is now in this camp of the dollar is going to weaken a lot. It's actually I think you're seeing that it's going to weaken a little more here, but I think you're going to see that it's going to put in a very big bottom, and that can last a little longer. But we're not talking years or half a year. I think we're talking a few months maximum. So, but again, we'll have to see it happen, and I'm not going to call it before it happens. I just say we can see that structural structural deterioration. Depth and the speed of the crash. I don't know if I can play devil's advocate on that. I mean, if you look at in terms of the valuations of market capitalization to GDP, if we go say that we all think, or we all know that we had a bubble back in 2001, or sorry, 2001, and also in 2000, 2007. If you look at the market capitalization to GDP, which is Buffett's preferred indicator, and I actually quite like that, well, then you can say if we just get to the level of 2007, we would have to go half in market size. That means that the market needs to crash by 50%. And we would still be at the level where the financial crisis began its decline. Try to think about that. And you still have a housing market this time that is also in a bubble if you look to the Schiller's price index. So looking at that and saying 50% before we get to that valuation level, and some, let's say 40% can't do the math in my head, on just to get to the .com level. I mean, that's crazy. That's insane. So we have a massive bubble, and that how much can it crash? It can crash quite a lot. Because there's one thing that is changing this time around, that's inflation, and that changes the game. Let me see if we can get some others. Yeah, how do you see SOL-based digital asset treasury companies, and especially, I mean, I think what we're seeing right now into the last phase here. I don't want. There's a lot of talk about the treasury companies and all that, and UPSI and so on and so forth. I want to talk about the crypto in general first, because when I'm bullish crypto at this point, and I'm saying you're going to see an amazing Altseason, that's because exactly what I said with the macro outlook. We're not at the end. We're not there where we are flashing imminent recession indicators. If we had that, I would not be in that camp. But if they were flashing and we could see everything that, credit spreads were starting to move up really strongly. We were starting to see yield spreads moving up strongly, short-term yields declining a lot, initial claims coming up. That's a different story. But what we are right now is where the Fed is kind of, oh, something is not right here. And the rest of the world, the Fed the central banks of the rest of the world are outright, cutting a lot, as I said earlier. Well, that's the time where liquidity starts to come into the system again. And for as long as, and this is where the liquiditists and the ones that are calling me out also, I know that, in terms of understand that there are big cycles that are defined by the macro cycles. And then you have the liquidity cycles, which goes within. And people who are confused by thinking it's all about liquidity can just look at liquidity and say, did that liquidity actually say the situation we had in 2007 and in 2001? It did not. So, but the liquidity will create an extreme phase into the final end. And especially when you start to see that people think the sentiment will be that, oh, the Fed has got our back. What to worry about? Henrik is just a fool. He's just a doomster. So all the liquidity that comes in now, and look at the stock market, it's doing great. Look at Bitcoin. Look at everything. And especially in that phase where you start to see the rotation into smaller to larger risk, which will be small caps, which will be altcoins and so on. That's an amazing journey. I mean, you'll see some of these going up 10 times, 50 times. And that's where we have the altcoin vector, which is a report and the signal, because there will be some of these that starts to move and they can move a lot. We are in that phase already, and people say, "Where is the altcoin? Sorry, the coin. Sorry, alt season." That's what I'm trying to say. The alt season is here. The alt season is when we start to see Ethereum outperforming Bitcoin, and you are definitely seeing that. So now we start to see that rotation. So Solana-based digital asset treasury companies may do well if Solana starts to do well. I think they will, because you're seeing the Bitcoin rotating into to Ethereum, rotating into Solana, rotating into something else. And in 5 to 10 weeks from now, it will be a completely different kind of risk environment. And some of you guys will also say, "Oh, Henry must be wrong because I've been, we're seeing things going straight up." Remember, that's what I'm saying. Things will go more or less. Some of them go almost vertical for some of these things, and that's where we want to ride that. That's what we do at Swissblock. We want to ride that. We're not naive. We know how things work, and at least we think we do. And we want to be part of that rally in altcoins. So that's why we have the altcoin vector report, which will help us to give an impulse. When does it start to move? It's always about when, and then an Elliott wave extension telling us how far can it move. So that's what we want to we do with that one. And then we also have the reports on Bitcoin and the likes. But that was more about how I see Solana and the likes. I think it's part of that, and of course there will be these digital asset treasury companies that will benefit from that, because if they are loaded up with Ethereum and other things and Solana and so on, then they will obviously be benefiting from that in a certain period. Will the Fed be forced to do quantitative easing the first 6 months according to your analysis? It seems like the liquidity is drying up. I don't know when the first 6 months are, but at some point, yes, they will. They will come out. Of course, everybody tells me also they will be coming out, in a big way. Of course, they will. So they will. They will think again, like what they live in a kind of one-dimensional world. They are two-dimensional. They can ease or they cannot ease, or they can be hawkish or dovish. And the thing is, actually, what they need to understand is that if you asked our grandparents, dear granddad, why wasn't it back in the 60s and the 70s? Why didn't you just, whenever you had a crisis, why didn't you just pour a lot of money into it? Because we have found out now here in the where we're so intelligent here in 2025, that you can just, if you have what is called modern monetary theory, you can just put a lot of money into it, and then by magic you can see the valuation of things going up, and you'll get a trickle down effect. And your granddad will probably say, "Oh my God, there's something called inflation." And we have not seen inflation for 25 years, 20 years, something like that, which is why we've gotten to this conclusion, which is so wrong. And this is what the Fed is going to realize. That's why this is going to be a harder crisis. This is why it's the everything bubble. And when it bursts, it's going to be bad, because the Fed cannot just get out. But they will try it. So back to your question, yes, they are going to try it. Liquidity, when they see liquidity drying up, and when the dollar starts to push up as hard as I think it's going to do, then they will have to crush it. They will have to do something about it. They cannot do otherwise now. They cornered themselves. So yes, they will do something about that. They will come out with the quantitative easing or whatever it's going to be. They will hate it, but they will do it. And they will also, by the end of the day, rather see inflation. They'll never say that. Then they will see deflation. So that is to the question. They will when, how much, I can see, with the kind of bubble we have, and when that floor opens up and the dollar flows into it. You have to understand, we are all more or less, if you have a mortgage loan or some kind of loan, we all more or less short the dollar, because when the dollar then starts to, because every debt in the world is kind of connected to a dollar in a certain way through the shadow banking system and all that, the euros dollar system. So if the dollar starts to rise, it'll be a problem for a lot of businesses, for and for a lot of countries, also emerging markets and the like. So this is why the nobody likes a dollar that is strengthening, and if it does that, as I think, then the hole is going to be big, and the only one who can fill it up is the one who sits on top of the printing press, and that will be the Fed, and they will do that. Why I am so sure about the Altseason, because if you look to the Bitcoin dominance index, it's really, you look at divergence on the weekly, look at the weekly chart, and look at the divergence you have in terms of the top, which goes into a wedge, and then you have the topping on the RSI, which is declining. That you only see into very big tops, and now it's been declining for, I don't know, few weeks, few months actually, or something like that. but it has much more to go in terms of Fibonacci extension. So you're going to get a nice alt season as I see it. But again, I can be wrong, obviously, but that's how I read it. There are other indications as well. Fabio is saying, I believe that in order to see a starting of the capitulation in the economy, the unemployment has to rise substantially from here. But in order for that to happen, the stock market has to capitulate first. Otherwise, the economy can survive very long. Wrong way, man. I got to say it's the wrong way around. Look at it. Look at it. Just go study it. Take a look at the unemployment level and tell me which one is telling you things that is topping first. You'll see unemployment level is bottoming before the stock market is topping. Take a look at 2007, for instance, as I said. This is what you need to understand. The stock market is dilutional. That's where people are thinking just like that and think that the stock market is taking everything in. But the stock market doesn't see the cyclicality of things. I am completely in disagreement with that. But that's fine. But take a look at it. It's not like that. The stock market will drop at some point when it realizes that the economy is not as strong. It's like what the Fed just, Powell came out just the other day and understood, oh, actually, I've been talking about that the stock market, sorry, that the labor market has been so strong, but now we see that it's not that strong. The stock market will give the same. And right now, it's running on the fumes, even though it can go a lot higher. In a world where productivity rises, the cost of goods and services will trend down. AI unemployment numbers will be more and more detached from financial market behavior. Be careful. Be careful. I mean, yes, productivity levels are great, but don't tell me we haven't seen this before. Now go back to the 1920s. You just saw the technology of a radio. You saw the technology of the conveyor belt and for industry production. Ford introduced that. You saw the car coming out, and you saw electricity. Don't tell me that these were not technological advances that made a difference and where productivity came up. What happened in 1929? People had front run that and thought that because of technology, you are going to be guaranteed a return. That's the problem. You're not going to get a guaranteed return. And if things are getting too frothy, of course you can see that the productivity levels will go up. And I'm the one of the most optimistic people in the world when it comes to the advances that the technology can do for us. I don't think we're going to see global warming as a problem in a few years. I don't think we're going to see, food shortages in some places in the world going to be the same kind of problem because we will solve these things. We are solving it with productivity and with the technology. Technology and then productivity. Productivity is going up, yes, but it doesn't mean that it can support the kind of stock market you have. And an economy can decline even though you have productivity gains. That's where it is. Will dollar go up over the next weeks before recession? Next weeks is very, very short time. No, next weeks, I think the dollar will still decline. And then I think into the recession. You can have that in the recession, actually go back to 2008 as well. When the floor opens up and you start to see some of the problems coming out and the bubble bursting, people will have to restructure, will have to pay back debt, and that's the problem. That's where the debt, where the dollar starts to run out. That's where the liquidity shortage can be coming. So you'll see that the dollar will start to move up, not because the dollar is a great thing and has been misused in many ways, and I'm all with that, but because of the whole entanglement of the dollar in everything. So that it starts to go up and it can have a self-enforcing effect. And even if you look at the dollar, it may be a very dirty shirt you got right there, but it's still the cleanest of the ones that you have around the world. And I don't mean any disrespect to any countries or anything, but I would not be holding my money in yuan or in even in euro these days when the recession sets in. I want to be in the good old greenback, even though it's a damn dirty shirt these days. In spite of foreseeing the fall of crypto as a future asset building, you are investing in SBET and other companies benefiting from the crypto industry. Do you expect crypto to fall before or after this fall? I think that yes, again, there is a difference between what I invest in short term and what I think I invest in because I think it has a fundamental value for the long term. So if I had to go with something that has a fundamental value, then I would look into what could actually really redefine the world. And if you think that, I don't know which crypto could redefine the world for you, well, that's up to you. That's not what I look at right now. I look at a speculative bubble in crypto. But that speculative bubble can go on for some time, and I want to ride it, and that's why we have the altcoin vector, as I said, and I follow the signals, and when the signal comes in, I go check out the chart and say, oh, this one looks like one I want to invest in. And yes, SBET is one that has and this is not an advice or anything, as we said also in the disclaimer. But I look at some of these and say, obviously they hold a lot of Ethereum. I think they are going to rise because Ethereum goes up. My personal perspective. How much Bitcoin dominance, do you expect an estimate to drop this time when Altseason peaks compared to 2021? Actually, I don't think we have a setup like what we had in 21. And if you look at it, actually, it looks more like we could see something that we had in 2017. This goes a little too far for the conversation today, or my monologue for today, I would say. But I think that it can drop quite far. Can't remember the numbers just here, but actually further than what you saw in 21. So I would expect more of an upside in alts and more of strength in the altcoins versus the Bitcoin. In case of recession, which are the assets that can hold value? Yeah, but that's it. Again, remember, a recession can come from different reasons. We didn't see a recession in 2022 where people thought we were in a recession because inflation went up. We can have recession-like outcomes both in the stock market and in the real economy when you see, something like inflation. But what I'm talking about in terms of recession here will be first a deflationary bust. And a deflationary bust is what I talked about before, is simply where the bubble bursts. So everything that has been inflated will burst. And guess what? Palantir is going to drop. Guess what? Nvidia is going to drop and drop a lot. That's what I see. So some of these assets that has been talked up, everybody's just on that side. You know, how can you even say that? And the earnings are much better and all that. When you have the Eiffel Tower, it's going to go, there's another side to it, and it's going to come down quite strongly. And so in terms of a deflationary development, you want to be in the dollar, because the dollar is where people be running to. You want to be in bonds, in for what you can call safe havens, so like German bonds and the US and so on, because these will be the ones that will stand strong, and you'll see the yields will be coming down. I know people say, yeah, but this time is different. I don't think it is. It's different from a structural perspective because inflation will probably go higher over the next many years, but that's not the same as asking me what's happening into a deflation. So over the next many years, I think inflation will go up, yields will be going up, but into a recession, deflationary development, you're going to see yields coming down, you're going to see the dollar strengthening. And actually, apart from that, I would be very careful, because there may be that you cannot just get all out of everything because you have so much money, and it'll be difficult for you simply to. So then I'll be in stocks that I know will prevail over the long time frame and will weather the storm. And but that takes more time to sit and go through that. What is cheap right now that could perform very well during this downturn? The dollar, I would say, and bonds, as I just said. AI bubble. Can we expect a large correction, 50 to 60, 70% for Nvidia, Meta, Microsoft in 26? Let me just put it like this. If we saw a 85% decline in the bubble that had 136% market capitalization to GDP in 2001 to the bottom, so 85% decline. What do you think we're going to see if the market capitalization to GDP is 220% now? I think you're going to see a very big decline. Could we see 50% decline for some of these? I think it's very possible, and also more. So I would be as I showed you just before, the FANG stocks don't seem to be right there yet at the point. I think they can rise more. I think the entire stock market can rise more. But from the peak of that, 50%, I would say there's a pretty good chance of that. Gold inflated. I think gold. Let me just say this again, and I said it also in an interview yesterday with Julia LaRoche. I have been wrong on the perspectives I had on gold, because I thought that it would reach and it would be developing more like what we have seen with silver, with gold miners, and also with platinum. Gold seems to have been front-running things, and that happens also when the narrative gets stronger that we have inflation. I didn't see. So that's why gold has been moving higher. Does that change my outlook that if the dollar is going to strengthen, that gold cannot come down quite strongly? No, it does not. Actually, it gives us other perspectives in terms of how far we go. So when you say something a few years ago, what gold was at one point, of course, I'm not going to call that again. But I think you are seeing that gold has been reacted on the inflationary narrative that is going on. And I think if you look to one very important thing, I put that up also on X at some point, where you look at the SPX gold ratio. Look at that. Then we have four times when we have seen this breaking down strongly. It was 1929, where there was a huge speculation into that top. And we saw that SPX, the S&P 500 versus gold, or denominated in gold, broke down, which means that gold had a good period after that. We saw it again in 1971. 1971 was because of what Nixon did, removing the convertibility of gold, which created that situation where we had a disbelief or a mistrust in the U.S. monetary system. And then, it's kind of sorted itself, but gold actually had a fantastic time after that versus stocks. Fast forward to 2000, the same thing again. This was more about the speculation into the top. What I think we have right now with this breakdown we see in SPX or the SP 500 in gold terms is actually due to two things. The massive speculation we have right now, which create a situation where people start to think, oh, maybe this is not going to end well because there are some clever people out there. And then you will see also that there is a mistrust maybe in the monetary system. And I think those two combined have maybe driven gold also a little further than I expected. So I think it has a short-term too high a peak, but I actually think this could be one of it's the beginning of the next rally, which means that every new rally has a peak up, it comes down in wave two, and I think the wave two is what we're going to see. So inflated, yes. If you look to what the inflation level is and the narrative behind it, then I think it's too inflated right now, and I think it's going to come down. Would I buy it if it comes down? Absolutely. And I think the commodity cycle that we're going to see coming out of this here when the Fed comes back in is going to be absolutely astonishing. So I think we could. I couldn't see Jasmine on your list. Are you out of that now? And why Luna not AIO set and so on? Yes, I am. I'm not out of that. I have Jasmine and all that, but it's again not recommendation, all that, guys. But I hold this. I post what I have on a certain what is a more you can say structural account, and then I have something which is more play. And I have to say, when it comes to Jasmine and some of these, it's more of a play money that I play around with. So because I don't see long-term value in some of these. So but yes, I am in those still, Jasmine and others. But do not just follow. As I said before, I have no understanding of your risk profile. So this is not advice or recommendation at all. So when to get out of dollars? That is the question. Yeah, pretty much. I think that is a very good. First of all, I think we're going to see Dixie going to 117 to 120. Because if you look back in time, you'll see, and technically, it seems to be a spot. So where if you go back to 2001, there was a level there. We actually were there for a few years. I think you'll see it spike up to that, and when you then see it's like in the Big Short, one of my favorite movies. I think it's absolutely fantastic. That he says, well, I think Bernanke just came out of the of Congress or something. Just went to to Congress. I think it will be a similar moment. Not again. Remember, history doesn't repeat; it rhymes. So something similar to that. So when we see that kind of thing, then I think combined with that level and the peak fear is at the highest fears at the peak highest, well, then I think the dollar has probably peaked out. Do you think paper gold is enough, or should we hold? I think gold is should be holding both. I mean, I prefer to hold. I hold physical gold that I've been buying ever since my early days actually, and so obviously holding on to that. And I will build it also, and I will be buying physical gold at some point as well. I'm not in the camp where I think they're gonna take away everything, and so I don't think we're gonna get to that. There will be a need for some kind of a resetting of things at some point, I think. But I think I think I may be naive. I don't know, but I think also paper gold will be okay. After cash out in crypto and stocks, where to park the money safe? I think I talked about that with the dollar and bonds and so on. I think that's at least where I will be parking mine. What commodities will you recommend, and when will the commodity super cycle begin? Again, commodity super cycle actually began in 2020. So look at the commodity charts and then see the extreme spike you have, and actually have a very nice five-wave structure. Then look at where you can see a 61.8 Fibonacci retracement of that. So take the full length and then take a 61 or 50% around that level. When we get down there, and that I think is going to be into the deflationary bust. If you look at that, that's the time. So it's not when, it's where. And it can be next year, but it probably will be around the same time when we see the dollar topping out. So the dollar topping out, and then the max fear and the Fed coming out with something, then I think we could see this kind of bottoming into commodities. How much is your ETH target? Assuming Bitcoin has topped around 125K area, I'm not assuming that Bitcoin has topped here. I expect the Bitcoin to have one more move. I think people are expected to go to 250 or 400 or. I was been in some of these, I think it was called crypto town hall or whatever it was, and I asked when will it be a top in your in your opinion, guys? And big silence. And then I said, come on, at what point? There must be a point. At what point? Not before 1.6 million. So I was kind of, okay, I don't think I need to attend this any longer. I think you're going to see a 140 to 170 or something like that. 148, 168 is where I have my targets. I think you could see that for Bitcoin. And I think you're going to see that really a strong move coming. I think we have seen bottom here. Our models are suggesting that we have seen a bottom, as you can see also on Twitter. Please go to Twitter and actually follow our Swissblock. You'll see a lot of the models prediction of where we have the bottoms and so on. And remember, our framework has actually overperformed Bitcoin. This is not something I say. Jan showed it in the last seminar we had. It's actually quite strong. I have to give. I haven't built it. We have some really good guys out there, data engineers and so on. They just built something amazing there. So take a look at that. But I think 120, 148, 168, I could see the difference, these two levels. I think we had that. But I also, if you go back go back in time and look at 2021 and look about 2017 and look at when Bitcoin topped and look at when Ethereum and altcoins topped. And you'll actually see that altcoins and Ethereum actually topped 3 to 4 weeks after Bitcoin. Actually, Bitcoin had put in the big top, come down, and in the final bounce it had, which is a wave 2, we actually saw the top in Ethereum and altcoins. And that gave us a 3 to 4 weeks lag for the top in altcoins and Ethereum. I think we'd see some of the same, and I especially think we'll see that because, and back to your Ethereum target, Arvin, because of the Ethereum Bitcoin ratio. And if you look at that, it seems like it can go to 0.10, 0.12, and if that's the case, even at current prices, Ethereum could go to above 13,000. So my target right now is actually 17 to 21,000. I maybe closer to 17 to 17,000 on Ethereum. I think we have an extreme move coming. And that's what I'm saying. Again, I do not want to stand out and saying, yeah, Henry, you said recession, but things are going up. Yes, exactly. That's the very peak of things. That's the blow off top that I talked about since 2022. That is now coming into this final phase. It's already there, as I just showed you, but it's already there, and it can go into an extreme spike into the final end of it. So 17,000, I think, something like that. How would you determine your exit strategy for an altcoin like Chainlink? My own approach involves monitoring Bitcoin dominance. I look to the Ethereum, to the different. First of all, go across the different ones. Just understand that it's not like Chainlink will do fantastic if a lot of others will not, and they'll start to drop. So they will be topping in some of the in the same period. So that's where we need to you need to go across there. But obviously, there's about having a good structure and a good method in doing how you risk manage. Okay, Fabio, you're saying thanks for the answer. Maybe I did not explain very well myself. My point is that I believe we have to give more value to some topics today than in the past. Wealth effect is much stronger. Yeah, this is the two, this time is different kind of talk, and I just don't buy into it, honestly. But it's okay, Fabio, as we don't need to agree on everything, and that's fine. That's where dialogue, and we have dialogues. And again, I would love to have dialogue with other people who have different opinions than me in terms of how we see these things. That's how we all could get. So please say that to the Raoul Pals and the David Hunter and the likes, because it will be amazing to see how we could actually, if we could all get more wise from discussing things with each other. I would love to do that. Can they just disguise the decline in the house price with money printing over time? That's the problem with measuring house price in fiat money. No, they cannot. They cannot just disguise things, because again, it's back to the real people. If the ordinary people aren't capable of actually buying the houses, then it can disguise it. So it's very difficult. All right, I think that kind of will a showdown with Raoul and Julian ever happen? Well, I mean, I don't think it's a showdown or a fight or anything. I just think it'll be interesting I have a few questions that I would like to ask, and I would like to have a dialogue with anybody. I mean, it doesn't need to be these two gentlemen. It can be with anybody else. But I think it would be interesting for everybody to talk, and we will all get wiser, right? And if we could just see, and I will be love to say, I learned something new today, and there's a perspective I didn't get, because that's the only way we can get better every day. So, all right, guys, I think that is it for today. This alt season is tough. Yes, it's tough to be in the market in general, and especially with something as volatile as crypto. But thank you very much, guys, and thanks for joining in this early morning for some of you guys in North America, and to the rest of you, and thank you for joining in from the the whole world. It's quite amazing. I'm humbled, really. Thank you, guys, and have a great day. Please note that this webinar does not constitute financial advice. Everything discussed reflects only our personal opinions on the topic at hand. Always conduct your own research and consult a professional before making any financial decisions. Participation is voluntary, and the information provided is intended for educational and discussion purposes only.